Yeah, I mean, this is pretty standard fare, really, isn't it? I think if you go back and look, for example, in the period leading up to the global financial crisis in 2007 and 8, we saw that there were several bombs which went off through 2007 and the first part of 2008, which, were strong hints as to the underlying challenges that lay ahead. And the bond market really sniffed out that there were problems, and equities, kept marching higher and made a few new highs along the way. And indeed, when then, the statistics agency in the US officially declared the beginning of the recession, it actually turned out to be in December 2007. So throughout that period, there had been a recession happening, which was not being reflected in real time data. So it's not too unusual to see the bond market somewhat more skeptical or circumspect about the economic prospects. And indeed, I think Tina still, the psychological factor can't be underestimated. Equity investors have for at least a decade, if not longer, been rewarded for buying every dip. And that Pavlovian response is difficult to fight back against. It will slow and it will stop happening when investors lose money engaging in that strategy. And again, so far, they haven't really done that.
And I suppose also this generation of investors largely haven't been in an interest rate environment like we're potentially heading for, an inflation environment, for that matter, that we're in right now. What do you think of the term aggressive that is being used over and over again to describe the Fed's likely policy path? Is that really a fair categorization, even if we do see them go ahead and raise interest rates by 50 basis points at multiple meetings this year?
Yeah, I mean, what the market is pricing, I would definitely describe as aggressive. And what the market is pricing is, a little bit above the median dot that we saw from the March meeting. So by extension, the Fed's own policy expectations are fairly aggressive as well. I struggle a little with some of the nuance here. I struggle to understand why the March meeting was as kind of cautiously communicated as it was, if we were then just going to have this barrage of aggressive and hawkish Fed communication immediately after. Maybe that speaks to the lack of a market reaction or the non-desirability of that market reaction. But 50 basis point hikes, we haven't seen those since 1994. And the Fed is openly courting those, and the market is quite happy to price them. So I think we definitely have to characterize that as aggressive. I'm still a little skeptical that we'll be able to deliver everything which is in the market currently without there being more disruption than we're seeing currently.